Hubbell isn't a household name, but it plays a critical role in keeping the lights on, literally. As demand for electricity surges and the grid gets a long overdue upgrade, Hubbell stands out as a quiet compounder at the heart of this transformation. Before we get into Hubbell itself, let's zoom out. The real story starts with the US power grid, aging and overburdened. This backdrop is creating a once-in-a-generation investment cycle. First, decades of underinvestment in the US electricity grid have left behind aging components, transformers, clamps, insulators, all in need of replacement. Add to that growing demand from renewables, electric vehicles, and data centers, sectors that rely on stable, high-capacity power. Put those two forces together, and you get a major structural growth opportunity, one that's unfolding over decades, not quarters. The US grid isn't just old, it's strained. Over 70% of transmission lines are more than 25 years old, and outages have doubled in length over the past decade. This isn't just a maintenance issue, it's a national priority. That's why we're now seeing over $15 billion in federal investment aimed at hardening and modernizing the grid. A major tailwind for companies positioned to help rebuild it. The investment isn't theoretical, it's already happening. Both distribution and transmission capital spending have accelerated meaningfully in recent years. What was once growing in the low single digits has now shifted to mid and high single digit growth, and that's expected to continue. This kind of sustained infrastructure investment is rare, and it's creating a multi-year tailwind for the companies supplying the backbone of the grid. And it's not just about fixing the old grid, it's about building capacity for what's next. Demand is being driven by a wave of growth in renewables, battery storage, EV charging, and data centers, all of which need more power, delivered more reliably. This isn't a short-term trend, it's a structural shift in how and where electricity is used, and the grid needs to evolve to keep up. Looking ahead, electricity demand is only going one way, up. McKinsey projects it could double by 2050 because so many parts of the economy are switching to electric power. This is where Hubbell comes in, a pure play on grid modernization, positioned right at the heart of this massive investment cycle. Hubbell makes the physical components that keep the grid running, from connectors and clamps to enclosures and switches. Its products are non-negotiable, and everywhere, in transmission lines, substations, and distribution networks. And they're essential for integrating renewables, EVs, and data centers. In short, Hubbell is a behind-the-scenes enabler of the grid and a key player in over $15 billion of federal infrastructure investment. Hubbell's competitive advantages are what make it a durable compounder. It's not just what it sells, but how deeply embedded it is in the system. It's a market leader in grid equipment, with components that play a vital role in keeping power flowing. It has sticky customer relationships with utilities and industrial clients, the kind that don't switch suppliers easily. Its broad product portfolio spreads risk and positions it to benefit from every corner of the grid upgrade cycle. And it's a trusted name, known for reliability and safety, which matters a lot in a risk-averse industry like this. Hubbell's revenue growth has been remarkably steady, even through shocks like the global financial crisis and the pandemic. That consistency reflects the nature of its business. Grid maintenance isn't optional. Utilities have to keep the power on, no matter the macro environment. Over the past 15 years, Hubbell has grown revenue at a steady 6% compound annual rate, not flashy but solid and reliable. And what's notable now is the shift. Recent growth has accelerated, and management expects that momentum to continue. As we can see here, that acceleration is being driven by structural demand across multiple end markets. Grid infrastructure and automation are growing steadily, while data centers and renewables are expanding even faster. Management now expects 6 to 9% annual growth through 2027, a clear step up from the historical average. Hubbell's margin profile has improved meaningfully, thanks to cost reductions and a greater focus on higher margin utility solutions. Gross margins have expanded to over 35%, and operating margins are holding near 20%, a clear sign of pricing power and strong execution. Return on invested capital is one of the cleanest signals of business quality. And here, Hubbell holds up well. There's some natural fluctuation, as you'd expect for an industrial, but the long-term average is strong, and the recent uptick reflects the margin improvements we just saw. This tells us the company isn't just growing, it's doing so efficiently. This chart looks busy, but the takeaway is simple. Hubbell runs a disciplined, financially sound business. The blue bars show debt levels, which have remained conservative, consistently under 2 times EBITDA, and the red line tracks free cash flow conversion. For most years, Hubbell has converted more than 100% of its net income into cash, a sign of strong underlying economics and tight financial management. Like any business, Hubbell isn't without risks, and these are worth monitoring. First, it's tied to infrastructure spending. If government or utility budgets tighten, growth could slow. Second, while the company is well positioned today, falling behind on technology, especially in grid automation, could weaken its competitive edge. And third, increased competition could put pressure on margins if others try to undercut on price. None of these are immediate red flags, but they're real risks that come with the territory. If you're tracking Hubbell going forward, these are the metrics to watch. Organic sales growth. Management is guiding for 6 to 9% through 2027. Operating margin. They're aiming to push this to 22.5%. And free cash flow, ideally staying above 100% of net income, which signals disciplined execution and financial strength. Bringing it all together, Hubbell scores 8.1 out of 10 on our quality framework. That's driven by strong competitive positioning, deeply embedded customer relationships, and a clean balance sheet backed by consistent free cash flow. It's not a household name, but it's high quality, with the fundamentals in place to compound steadily over time. To sum it up, Hubbell is benefiting from powerful, long-term growth drivers with clear visibility through the rest of the decade. It's uniquely positioned as a pure play on grid modernization, a space that's critical and chronically underbuilt. And it's a high-quality business by our framework, with the attributes that support steady, durable compounding. If you'd like to dive deeper, you can download the full one-pager at compounding-academy.com. It brings everything together, from financial metrics to competitive positioning, in a single snapshot. It also includes our quality score, which reflects our proprietary framework for assessing long-term compounders. And while we don't include valuation in these slides, to keep them timeless, we do update our valuation views regularly, and that's something we reserve for paid subscribers. If you enjoyed this overview, don't forget to subscribe for more concise takes on high-quality companies. Like and share if you found it useful. It really helps us grow. And for more deep dives, head over to www.compounding-academy.com.